All right, everybody. I wanted to record myself going through my study guide that I created for my options and futures class, which is on this Thursday on the 12th, I believe. It's the 12th. And I usually don't record videos of myself going through my study guides. However, I was eating lunch this one day with my teammates, and he told me you wouldn't be able to create these study guides without AI. And that hit me hard because I can't be having that type of reputation around on campus. So tonight, I'll show you folks how it's really done, and let's ace this exam. All right, so first, let's get into our agenda. So our learning goals. Before we could get into anything option related, we have to understand the fundamentals, the foundation. So we need to understand what an option is fundamentally, right? And that includes what a call is, what a put is, and how do contracts operate. Our second learning goal is payoffs and profits at expirations. So what do the terms in the money, out of the money, and at the money signal? We also need to understand the options cost in relation to premium prices. Thirdly, I'm going to go over graphs, which is going to be a large part of this document. I'm going to visualize what's going on when you actually trade one of these options. We're going to be able to, through these graphs, we're going to be able to see and define risk and reward, meaning when you trade an option, what are the potential losses that you can incur? And also, what are the potential profits that you can gain? Our fourth learning goal is going to be learning combinations and spread. This is probably the hardest part, or will be the hardest part of the exam, in my opinion, because things start to get tricky as you start adding things together, and you have to keep in mind many factors. So we're going to be talking about things like straddles and strangles, protective puts, and vertical spreads. And lastly, we'll do a short, quick intro on the Thinkorswim interface. Uh, there will be a screenshot of the interface on the exam. So in order to prepare and be successful for the exam, we need to understand the UI and basically what's where and where's what on Thinkorswim. This is a little disclaimer before we move forward. Know what you're doing and trying to accomplish when trading options. Know your risk and reward, and remember, your goal is always to profit in options trading. All right, section one, fundamentals of options. So options are derivatives that get their value from the price of other securities, meaning uh, these assets get their prices from another underlying asset, right? And these derivatives are depend or contingent claims because their payoffs depend on the value of other securities or their underlying asset. So a call gives its so in options trading, there are two uh, options you could trade, a call and a put. And the first type of option, a call, gives its holder the right to buy an asset. So this can be at the exercise or strike price or before the expiration date, whichever you choose or whichever is more profitable. Um, so the key idea here is to exercise the call option to buy the underlying asset if the market value is higher than the strike price. A put gives its holder the right to sell an asset, similarly at the exercise or strike price or on or before the expiration date, whichever is profitable. And exercising the option to sell the underlying, to exercise your option or the put when the underlying asset is below the strike price and market value. And lastly, the option contract. Here's just some basics you need to know. So the purchase price of the option is called the premium. Sellers and or riders, terms are interchangeable, of the options receive premium income. And if the holder exercises the option, which is the holder is the buyer in this case, right? The option rider makes makes call or takes delivery of the underlying asset, meaning that the option rider has an obligation due to the buyer if the buyer decides to exercise or decides to use his right to exercise his option. All right. Section two, payoffs and profits. So we'll first discuss market and exercise price relationships. So in the money, or ITM for short, is when you exercise the option, when the timing to exercise the option would be profitable. In the case of a call, uh, and the money would be when the exercise price is below the market price. And for a put, you would be in the money if the exercise price was greater than the market price. Out of the money or OTM means an exercise of the option would not be profitable. So in the case of a call, it would be when the exercise price is greater than the market price, and in a put, that when the exercise price is lower than the market price. Lastly, we have at the money or ATM. This is when exercise price and asset price are equal, meaning it's just a break even. So payoffs and profits. Here's some equations I would remember for the exam. I mean, we're gonna have a cheat sheet for the exam. However, I would try to grain these equations or payoffs into your mind, as the faster you're able to do options, the more better of a grasp you have upon them. So let's first define our terms. Stock price is ST and exercise price is X. So the payoff to a call holder, buyer, or the long position. Uh, so if the strike price is greater, or if the stock price is greater than the exercise price, your profit would equal to the strike price or the market price. Let's try that again. So if the stock price is greater than the exercise price, your profits would be equal to the stock price minus the exercise price. Your profits or your payoff would be zero if the stock price is less than the exercise price. The way you calculate profit is just payoff minus the purchase price or the premium that you're paying for. Payoff to the call writer, seller, or short position. If the stock price is greater than the exercise price, your payoff is equal to negative uh, stock price minus negative exercise price. And you will have zero payoff if the stock price is less than the exercise price, is less than or equal to. Same thing with the profit, or not same thing, but in this case, since you are the seller, you receive the premium from the buyer, meaning that you add the premium you receive from the payoff of your contract for the profits. So in this case, let's define our our reward and risks. So as a holder of a call, your profits are in theory unlimited. There's no cap on your profits, and your risk is defined in this case. This is because your risk is basically the premium you pay to the seller, right? And in theory, your profits can keep on growing and growing if if the underlying asset keeps on going up. And as a writer, your profits are defined. As a writer, you mainly derive your profits from the premium you receive from the buyer, right? However, your risk is unlimited as the underlying security can keep on rising, as we said. Now moving on to puts. So the payoffs to a put holder or buyer or the long position uh, is exercise price minus market price if the stock price is less than the exercise price. You have zero payoff if the stock price is greater than or equal to the exercise price. Your profit to as a buyer of a put is merely your payoff minus the premium that you pay. Something to keep in mind as a buyer, if you're in the long position, you're always going to be paying a premium to the short position. That's just how these contracts work. And moving on to the put short position, your payoff is negative strike price minus negative. Uh, let's try that again. Your payoff is negative exercise price minus negative stock price if the stock price is less than exercise price. Again, your profit as a short position in the put is your payoff plus the premium you receive from the buyer. And to clarify further, what the cost is in relation to premium prices. So the cost of a contract, of an option contract, is merely just the premium, which is the purchase price. There's, you'll notice in options tradings, there are many interchangeable terms. There's three words that mean the same thing, especially in this case. And on the exam, you're going to have to be able to calculate your return. So you could calculate your return by dividing profit by cost, or uh, dividing end value by beginning value, and then subtracting that number by 1. All right. I know I just spewed just a lot of equations and pluses and minuses at you guys. So I created these graphs to visualize what actually is going on paper. And if you didn't get much or you started to fall asleep in the last section, uh, I think things will make much more sense. So let's start with the long call, right? So here in a long call, your losses are defined by the premium you pay to the seller. And as that underlying stock price increases, your payoff or your profits start to increase. And this is the break even point, right? When the stock price is equal to the exercise price, basically ATM at the money. And right here, your profits can keep on going as they are undefined, as the underlying stock price can always keep on going up and up before before the expiration date. Here, inversely at a short call, your profits are defined by the premium you receive from the buyer over here. So as the underlying stock price continues to increase in price, your profits shrink and cross the ATM threshold into where losses are undefined, right? And to reiterate once again, losses are undefined because the underlying stock price can, in theory, go up and up uh forever. There's no cap on a stock price on the stock exchange. It just actually has to happen. It's not guaranteed. So moving on to puts. So in the long put, as your buyer, your profits are undefined, right? This is because you are betting as the long position on a put that the stock price will tank. And once again, in theory, the stock price on the market can always go down until it reaches rock bottom or zero, right? And you begin to lose at the break even point or at ATM when the stock price is equal to the exercise price. And when the market, the stock price begins to uh, outgrow the exercise price, that's when you start losing money, which is your premium. And your losses are defined because you pay this premium to the short position. In the short position, your losses are undefined because, as we said, the stock price on the exchange or the underlying stock price can always go down. And sellers' profits increase as the stock price and the exercise price become equal to each other at break even. And once it crosses that threshold, you start making profits from the premium that you receive from the long position. All right. Uh, Before I move on to section four, make sure that you have a deep understanding of all these positions, right? I would uh I would study these and be able to explain to yourself or to a friend what actually is going on before moving on to the next section. Because if you do move on to the next section, you will be, I assure you will be completely lost and things will just be even more confusing and ridiculous. Okay. So in section four, this is when we start combining and trading multiple positions and options at the same time. So the first type of these combinations is called a straddle. So a trader exercises a straddle when he expects the underlying stock to move, but he is not sure in which direction. So basically, if you consider trading a straddle, you are betting on the price moving. However, you don't know whether the underlying asset will go up or down. So in a long straddle, we combine a long put with a long call, and you receive or you're you pay the premium, which defines your risk. You pay the premium to the short position, and after we combine these two options, a long straddle looks like a V. So as we see, we're betting on the stock price to move either up or down somewhere in this area, but we're increasing that area because we just don't know which way. For instance, you could trade this uh, option when like some sort of news is supposed to break out, and you don't know if this news will be good or bad for the company. So you just slap a straddle on it and bet on movement. And and in a short straddle, instead of paying the premium, you receive it, which uh, defines your reward. However, uh, undefines your losses. So the next thing, or the next type of option trading is a strangle. So think of the strangle as the straddle's cousin, as they are related to each other. So like a straddle, you as a trader, uh, it's like a straddle. However, you as a trader are betting for the underlying stock to move even more than in a straddle, right? Uh, so you capture an even wider area. Uh, Due to this strategy, this leads the cost of this bet to be lower than the straddle. Because due to a strangle being further out of the money, uh, FOTM for short, this makes the premium lower for any option. So on the exam, you will have to explain how to convert a straddle into a strangle, right? And simply just do this by uh, right here, making the straddle further out of the money, which means you uh, have larger disparity in your exercise price, right? So this is the strangle. You pay the premium to the short position, and you're betting on that the stock will move in any area within here. All right. Our next option strategy is a protective put. So within the strategy, it entails owning the stock while putting a put option on it to limit the downside risk. And this protects against losses if the price falls while keeping the upside potential of owning the stock. And there are many scenarios where a trader cannot trade away his stock due to some reason. So he protects his capital gains using a put. So to visualize it here, this is the underlying asset that you own, and this is the put that you traded in. So you define your risk, how and keep your reward undefined. And this is because your loss will always come from the underlying asset that you own. If your capital gains become negative, you are offsetting that cost through your protective put here. The last thing before we get into vertical spreads is called a collar. So a collar is basically a protective put plus a short call. And this strategy caps both the upside and the downside. So here we're adding the short call. And in this position, you kind of want to cap your upside because, okay, maybe the stock won't drop that far. So you're not extremely bearish, but you're bearish to a point where you want to cap cap your or define your profits. Okay, vertical spreads. So vertical spreads are another combination of calls and puts, but uh only between calls and puts themselves. So we won't see any intersection between a call and a put, just a call and a call, a put and a put, right? Our first type of vertical spread is a bull call spread. So it contains two calls with the same expiration but different strikes. And in this case, the strike price of the short call is higher than the long call. And by trading the short call, its main purpose is to help pay for the long call's upfront cost, because as we remember, the long call or the buyer always has to pay a premium to to the seller and you just want to use a short call to subsidize the cost of the long call right here. Our second type of vertical spread is a bear call spread. So it contains two calls, again, with the same expiration but different strikes. However, in this case, the strike price of the short call is below the strike of the long call. And due to the nature of the strategy, it will always generate a net cash flow at the inception or the origin of this trade. And before I move on along any further, bull and bear are two terms that you should understand. If you're bullish, that means you're confident in the market price going up, and if you're bearish, you are under the impression that the market price will drop. So these two positions are merely the inverse or the opposite of each other. In this case, you think the stock price will rise, and in this case, you think the stock price will decrease. However, you just cap your losses and your profit, and in this case, you cap your profit and your losses through financial engineering. All right. The third type of vertical spread is a bull put spread. Contains two puts with the same expiration but different strikes. And in this case, the strike price of the short put is above the strike of the long put. The short put generates income, whereas the long put's main purpose is to offset assignment risk and protect the investor in case of a sharp move downward. The investor will always receive a premium when initiating this position. So, like we said before, bull, that means you're confident the strike price, or excuse me, the stock price will increase. You're just capping your downside and you are generating a premium through the short. All right, and a bear put spread contains two puts with the same expiration but different strikes. That's a common pattern along all four of these vertical spreads. Um, I put, I just wanted to reiterate it for every one of these spreads, just so you understand this concept. And the strike price of the short put is below the strike of the long put, which offsets some of the cost for the long put. Because remember, in the long put, as a buyer, you are paying a premium to the short position. In this case, the trader hopes to profit from a decline in the underlying stock. Bear in the name makes sense. And the strategy requires a net cash outlay as you have to pay for the premium from the short put. Okay, last thing we will talk about is the Thinkorswim interface. So basically, you just need to know how to navigate this software. Uh, you need to understand an options chain. This is where all the options exist on the software. You need to understand uh this is seen across every trading software. Calls are on the left side and puts are on the right side of this option chain. And the sell price, you sell at the bid for a short and buy at the ask for long. Uh, I'm gonna go on to Thinkorswim and we'll see what we're talking about. All right. Conclusion. When trading options, know what you are doing. Like, be able to define risk and reward in your trades. Grasp a good understanding of payoffs. When are you in the money? When you are out of the money, and uh, when you are at the money, right? Trading's options is easy, while understanding what you're getting into is not, right? So, bottom line, know what you're doing. You don't want to get into something and then you realize you're gonna have to get a huge haircut because you took on risk that you didn't understand at the time, right? Next, the past does not always predict the future. In finance, we always look to the past uh, to try and explain the future in terms of assumptions. And what I'm trying to explain with this point is also try to rely on patterns, not just raw numbers, understand current events and what is going on in the world. Your goal as an options trader is to profit. All right. If you're trading, you want to make money. Like that is your goal. You're here to make money. You're not here to just put to flush money down the toilet, right? Nobody wants to do that. Profit as a trader. And with that being said, life is full of ups and downs, right? Sometimes you'll win a bet and sometimes you'll lose a bet. That's just how life goes. Don't get too upset uh, if you lose any money when trading options, right? And experienced traders, they subsidize their risk, right? As when you're trading, you want to have as little risk as possible. We need to understand as traders, you can probably never fully eliminate a risk as things are rarely ever guaranteed. However, uh, we can always minimize our risk. And lastly, be intuitive, right? Use your use your head. Um, let your mind do the thinking. Don't don't trade based off of emotions or flash or like FOMO, fear of missing out of on the profits others people are making. Um, yeah, just be intuitive, be wise, be smart. Thank you for watching.